Hi guys, welcome to Financial Jaga Jaga. So I know it's actually been a while, but yeah, finally I found something interesting that I thought I should talk about. So guess what? On Thursday, the Monetary Policy Committee of Nigeria had a meeting, and in this meeting they reduced the monetary policy rate from 13.5% to 12.5%. So if you are someone that tries to keep up with businesses, I'm sure you must have seen it on various headlines, channels, news, or whatsoever it is you watch. And you might have been wondering, what does this even mean? So this is why I'm making this video, just to talk about what is the Monetary Policy Committee, what is the monetary policy rate, why did they reduce it, what is the possible impact on Nigerians, and then what is our reality basically. So I hope you sit back and enjoy. So starting, what's the Monetary Policy Committee is basically just a group of people. It's chaired by the central bank governor, and they come together. I think the central bank governor, then some deputy governors of the central bank, and then some economists that are appointed by the president and also the governor of the central bank. And why do they even meet? So they meet quarterly or once in 2 months, and then they sit and they just examine the economy, and based on the reality, okay, exchange rate is going this way, this is going this way, they then decide that, you know what, this is what we should do to tweak things to return back to normal. So they can decide that, okay, let's reduce or increase monetary policy rate. They can decide that let's increase or reduce the cash reserve ratio, and they can decide to increase liquidity ratio. So I'll not be talking about CRR and LR, which is cash reserve ratio, today I'll just focus on MPR because I just want this video to be short. So now, what is the monetary policy rate, the one they reduced from 13.5 to 12.5? What exactly is it? So in simple terms, it is simply the rate that the central bank lends to commercial banks in Nigeria, or banks in Nigeria. So if, let's say, GT Bank or UBA or Access Bank wants to borrow money from the central bank, that is the interest rate that they would have to pay central bank in exchange for money, right? So normally this rate is also now then determines the rate at which these banks give loan to the public. So because I'm a bank and I know that if I'm going to take loan from central bank is 13.5, it means that if I'm giving you a customer loan, it can never be lower than 13.5, except of course the central bank is subsidizing it. It has to. So that is like the benchmark. Like, I look at the MPR and then I determine that, okay, my lending rate to you would be this. I look at the MPR, and then sometimes too, it also determines when you save your money with the banks, that interest, savings accounts, fixed deposits. Sometimes the banks look at it and they're like, you know what, if monetary policy rate is 13.5, then the cost of I'm going to pay customers maybe 30% of that or 25% of that. That's sort of like a benchmark for interest rates in Nigeria. And also that rate also sort of determines the rate at which the Nigeria issues bonds. So if the Nigerian government wants to borrow money from locally through bonds are simply like the government is coming out to borrow money from you. So they give you that document and then you give them your money, and it's called a bond because it's long. So it's over 1 year. So it's like 2 years, 3 years, that kind of thing. So now this brings me to my third question. Why exactly did they decide to reduce the monetary policy rate? Yeah. So the truth of the matter is that many African countries, if not just African countries, many countries lately, Thailand, South Africa, Gambia, Zambia, Rwanda, and so many other countries, they've decided to reduce their monetary policy rate in recent times, and that's just because they want to drive economic expansion. I feel like I'm saying a lot of big words, but in simple terms, they reduced that rate because they want to make the economy better. They want to create jobs. They want to so let me just explain it now. So now, if they drop the rate, it means that banks would also reduce the rate at which they lend to people, right? It means that small business that's been trying to get loan from the bank, but because the rate has been so high, they can go and get loan from the bank. They can improve their business. They can employ more people. And also people would have, like, I mean, there'll be more money in the economy, right? And so it would just have like a ripple effect of making things better. That is the general, like, so most times when economies see that there's like a hard time coming, a recession ahead, they tend to reduce the monetary policy rate to see if they can still salvage the situation, to see if they can still, mend things. Can we still do anything? So they reduce that rate, and the ripple effect is meant to make things better. However, my people, I don't know if this is going to be Nigeria's reality, because I remember putting this thing on my status, and some people engaged me and they were like, Nigeria, that this monetary policy rate does not affect anything in Nigeria, it's just official, it's just. So basically the reason generally why monetary policy rate is reduced is so as to aid economic expansion, like I've explained. But in Nigeria, based on historical data, based on what we see in the market, right, it normally doesn't have such a huge impact like that, right? And in this time and season, right, let's say they reduce the monetary policy rate now. Even if banks reduce their lending rate, I don't think banks are willing to lend that much, because the risk of bad loans is high. So even if they reduce monetary policy rates, the bank may still say, you know what, I'm not going to give loan to this particular set of people, because what is the chance that they are going to pay me back? The economy, COVID-19, people are not buying things as they used to. So that effect, the main purpose of doing it may not really be seen, right? However, it may lead to, the only thing that me personally I can even see is the fact that, okay, maybe when the government issues the bonds, they will reduce the interest rate on those bonds, will actually reduce, right? So that means they'll have a lower cost of borrowing from us, the people of Nigeria. What else? It may lead to an increase in inflation. That is, well, but you know what? The impact is not really felt like that, because banks may still not create loans.